Good afternoon, traders and investors. Will back here with another one, coming to you with a Saturday video, guys. Hopefully everybody is having a great weekend so far. And in today's video, guys, we're going to take a look at some subscriber requests that we got over the course of the most recent week, just to do some very quick fundamental analysis on them and technical analysis as well, and determine whether or not they may represent some decent swing trade opportunities or some long-term buy opportunities as well. And after we go over our subscriber requests, since there aren't that many this week, I'm going to give you guys 4 stocks that I'm going to be looking to buy the dip on myself. So without further ado, guys, let's get right into today's video. So just a quick reminder in terms of what we're looking at when we're shopping for stocks, guys. Always remember this: a stock's price is a reflection of future earnings and future cash flows. This is very important, guys. Number one, because only if EPS and free cash flows are expanding will a stock's valuation be allowed to run to the upside as well. Now, a few of the things that I take a look out here for, guys, right? So don't chase stocks. Let the market come to you. It is so important, guys, to not get FOMO, not chase, because there is over 1,000 blue chip stocks in the market right now and over 8,000 different names that you can trade in general. So there is always a play if you know what to look out for. Now, number one, if you missed a name, check the industry peers. So let's say you missed a rally on American Express, you may want to check how the peers are doing, such as MasterCard or Visa. There may be some opportunities there as well. Number two, we want to be looking for stocks at big support levels, either daily, weekly, or monthly support levels, just because, guys, we're looking to shop for stocks at lows and we are looking for long-term bulls to be supporting those price action levels. So let's always be looking for stocks at very large support levels. Usually gives us a very higher probability of success if we're going to enter buy orders at that level. Now, number three, we want to be looking for expanding revenue and EPS. You will see that on every stock that we look at, I'm always looking for expanding revenue and EPS. Is the company growing in a healthy fashion, or is it stagnating or potentially declining, guys? It is very important, guys. Just because a stock could potentially be going down might not be an opportunity to buy, guys. You have to look if they're expanding revenue and EPS. If a stock's price is declining nonstop, but they're expanding their business, then you know that there's an anomaly. There may be a trade there. But if stock's price is going down because its fundamentals are deteriorating, usually that is a time to avoid the stock until their fundamentals turn the corner. Number four, we want to be looking for stocks with good free cash flow, just because that gives a sense of the business is able to operate and generate positive cash returns for its investors, and then can use that cash to either expand its business or reinvest into you, the investor, in the form of dividends or share buybacks. And number five, you want to be looking for companies with relatively low debt, especially in a high interest rate environment, guys. The companies that will perform the best are the ones that have the most cash on hand with very low amounts of debt. Now, the name of the game, as I said, a quick summary, guys, name of the game is to find companies with solid fundamentals and a great technical entry. And if we focus on these two things, usually we should be able to pick stocks at very decent prices and get those juicy compounding returns over time. So without further ado, guys, let's get right into our subscriber requests for the week. And we'll see, we have about 7-8 of them. So we're going to take about maybe 3-4 minutes each. And pretty much at the end of that, take a look at the stocks that I'm potentially looking at to buy some dips. Now, number one, we have Elizabeth asking, can we please do an analysis for DDOG? No problem at all, Elizabeth. Let's pull up DDOG, one of these cybersecurity plays in the market right now. So in terms of fundamentals, guys, there's really nothing wrong with this company other than the valuation it trades at. But in terms of your overall financials, right, take a look at the balance sheet. The balance sheet is relatively fine. They do have a decent amount of debt on hand right now, about $902 million. But you guys can see on a yearly basis how much free cash flow they bring in and how much cash and cash equivalents they already have on hand. So debt is not a problem for the company. They have been generating positive returns, and DDOG nicely improving on their net margins. This company used to not be profitable or barely not profitable, and now at least in the last 3 quarters, we've been seeing consistent bottom line income. So the company really rounding the corner and now turning into profitability. That is a very good sign for the company. Now, point number 2, do they have expanding EPS and do they have expanding revenue? Yes, EPS, very gorgeous expansion curve right now, and the revenue also very gorgeous expansion curve too, which gives us analyst price targets really to the north, maybe of 140. Most analysts are pretty much sitting up here 140 to around the $160 range. So they do see some capacity for the stock price to appreciate. Now, where are we sitting, guys, on a technical level? Well, in terms of the technicals, guys, very, very simply, right? Who is in control? Well, our longer term bulls are in control. It is a very nice current monthly uptrend, which is pretty much on par with the rest of the cybersecurity industry, right? They really bottomed out lower 22, and a lot of these companies are in very juicy uptrends right now. Currently coming down, trying to find that monthly higher low, anything above 77, just looking for the monthly higher low for the further trend continuation. So I do like this area to maybe bid some Datadog, especially since we're between the monthly moving averages right here. That's pretty much, let's call it between $112 and around $100. Very, very sweet location to be buying some Datadog for a longer term portfolio addition, right? Now, in terms of the weekly, obviously our short-term price action is working against us, still trying to find the weekly bottoms, right? We have a nice weekly engulfing move last week. So essentially what we're looking for here, guys, is to confirm that our monthly higher lows are found. We need to eventually see a recapture of this weekly uptrend. And only when we recapture this weekly uptrend will you be pretty much positive that we can get that next monthly leg higher. This one pretty much probably will not move on its own, guys, just because even though it's a very good company, guys, it doesn't necessarily have a differentiating factor versus a lot of the other cybersecurity plays, right? There's a lot of cybersecurity plays in the market right now, and your two industry leaders are these guys right here, Palo Alto Networks, and number 2 is going to be CrowdStrike as well, right? Obviously, the product offerings between these companies can slightly differ, but we can compare them on a common denominator. That's why we use the PEG ratio, right? So very good growth metrics. However, since their EPS is so small, it is growing though, their EPS is so small, guys, that when we take their PE ratio at $117 right now, it's a 73.5. And even with a 21% per year growth rate, it gives them a PEG ratio of 3.5. Quick reminder, anything under 1 is very good. Between 1 and 2 is okay. Closer to 2 is getting a little high. And anything above 2, guys, is pretty high in terms of valuation. So even though it appears that the stock is at a very nice discount from share price from the all-time highs, the valuation is still very high. So this is when I like to look at some industry peers to see if we can find some companies that are also in the same type of technical pattern, but maybe their valuation is a little bit lower, which can help keep the support up in the stock price, right? So let's just take a look at a couple of them. Number 1, we can take a look at Zscaler, one of their peers as well. You can see virtually, for all intents and purposes, same technical pattern, but their PEG ratio is a lot lower. So much cheaper company and relatively the same in terms of fall off from the all-time highs, right? Another one, of course, we can take a look at the industry leaders, CrowdStrike. CrowdStrike is one, even though they are the industry leader by a wide margin, their valuation at the all-time highs right now is very, very rich. So this one too, very tough for me to chase up here. The other one we're going to look at, guys, is Palo Alto Networks. Palo Alto Networks, not too far from the all-time highs, gorgeous monthly uptrend as well with a little bit of pullback, right? And now trying to continue the trend expansion. Their PEG ratio is about 2.4. So not the worst compared to CrowdStrike and let's say Datadog, but still a little bit high. The one actually with very good valuation, guys, and that is a profitable company, which is why it's the one that I place so often on the channel, is Fortinet, one of the companies that has the best net margins in cybersecurity. And we can see the technical pattern, although it's not that far off the all-time highs, it is a very, very nice range of consolidation. In the lower areas right here, 56 down to about $46, very nice area for entries, and the PEG ratio is not too bad. So hopefully that allows you to compare a lot of these cybersecurities between and amongst each other and determine which one could be the best play for you. Now, obviously, if Datadog is your preferred or favorite company, that is perfectly fine, guys, but at least we need to compare between its industry peers to determine whether or not it's overvalued compared to the industry peers or undervalued. And as of now, unfortunately for this company, it is kind of high relative to its industry peers. So hopefully that makes sense. Now, number 2, we're going to take a look at, for Rick asking us here, take a look at AFRM. No problem at all, Rick. So AFRM is a company that I used to play very, very, very heavily back here when money was virtually free, because it was pretty much a very, very easy play, guys. AFRM was starting to partner with companies like Apple, Amazon, and was offering 0% interest rates for buy now, pay later, just to get their brand out there, right? Well, unfortunately, now times have changed and interest rates are a lot higher, and the company has unfortunately gotten crushed in the process. Now, let's take a look at a few of their company fundamentals right now. So if we want to pull up Affirm, unfortunately for them, they are not a profitable company, so not net margin positive as of yet. And in terms of the expectation for profitability, guys, you can see expectation even through 2027. Unfortunately, on an EPS basis, the company is not going to be profitable. At least that's the expectation. Now, revenue is growing steadily, but as long as the company can't bring any of that revenue to the bottom line, they're going to have this type of problem, guys. The problem is that the debt is going to continue compounding to the upside because they're not making any money on the business. So be very careful with this. If in the event they cannot raise more debt, what do they have to do? They have to obviously issue more shares. And if we take a look at Affirm shares outstanding history, let me just pull it up. So if you take a look at the shares outstanding, guys, this is why you need to be careful with some stocks like this, especially when the macro environment is not in their favor, right? So take a look at this share dilution, right? Shares counts completely going up right now. Now, not by a very wide margin, but this is just basically shareholder compensation, right? So management and executives, their share compensation packages, unfortunately, are leading to increased dilution in the stock. So far, they have not had to issue a bulk more stock to raise capital, but still, guys, need to be careful because the cash and cash equivalents right now are about 1.62 billion, and it's not enough to really service most of that debt, right? So got to be a bit careful with Affirm in terms of that respect, right? Now, I do think the company is still growing favorably, but just it's not the right macro environment for them right now. So in terms of the technicals, guys, well, technicals, we are in a technical monthly uptrend right now, hunting for the monthly higher low to potentially recapture some of these highs. Maybe when the macro environment gets better, this company will do amazing when rates actually start coming down. But for now, guys, all of the movements, right, on Affirm are mostly speculative bets whenever the talk about interest rates, the frequency about interest rate cuts goes up, right? So this is why the stock really get a big raise in November and December, because we were talking about maybe 4 or 5 rate cuts this year. And as you can see, as those expectations have kind of gone away, that is why Affirm hasn't been performing too well in terms of the stock price, at least. So what we're potentially looking for here, guys, is the bottoming out process of this monthly retest area. And that's going to be maybe between the $27 and $20 range. Lower as we can go, guys, 25 and below seems to be a very juicy swing trade opportunity for Affirm potentially, especially if you want to write any short puts. Maybe if we come back down here, 27, 25 region, you could potentially be writing some short puts because this one does have some good volatility. Maybe 22 all the way down to about $20 seems to be a great location for the stock. And even if you're trying to build a longer term position, if you truly believe in the company and it's one of your favorites, I do believe the risk reward profile severely gets better as we go down into the lower $20 range, just because then your price to sales gets a lot better right now, right? So in terms of the market cap, they're sitting about 9.55 billion. And in terms of the amount of money they bring in on a year as of last year, it's about 1.6. So not the best price to sales, guys, if I do say so myself, right? If we divide their current market cap, let's say 9.5, divided by their annual sales of about 1.6, let's call it, it gives them a price to sales of about 6. That is a little bit rich, even for a growth company, especially when they're not making any money. So just keep that in mind, guys. That valuation would come down significantly if we were to revisit the lower $20 range. It becomes a much more manageable valuation. And as I said, the risk reward profile gets a lot better because then we really start falling into some of these lower support areas that were withheld pretty much in the later part of 2023. So that is what we're looking for on Affirm. Now, in terms of your short-term technicals, guys, what do we need, of course? Well, we are looking for that desperate weekly uptrend conversion, and only then will you know that your new monthly upswing is started. So hopefully that is educational for anybody who's looking into Affirm. Thank you very much for that one, Rick. Now, let's move on to I don't know how to say your name. Is it T.A. Sadar or is it Tassadar? I'm not too sure. But anyways, looking at CELH and Oracle. Can't find a good entry now on Oracle, and CELH just seems to be breaking below support levels. Any TA or some advice on them? I'm scaling into CELH right now and waiting for Oracle to come down. No problem at all. So these are two very tricky companies. Number one for Oracle, right? If you haven't seen my video on Oracle, we literally just did a earnings recap on Oracle last week. So if you haven't seen it, definitely take a look on my channel. Just search on my channel for ORCL and you'll be able to find that video. It's literally from last week. That's for the full fundamental breakdown, right? We broke down everything. Their PEG ratio, even at the all-time highs, guys, is not that bad, about 1.56 as a whole. So even though they are all the way up here, their valuation isn't really that bad, right? In terms of their fundamentals, I mean, we went through them for the video, but let's do a very quick recap, right? Fundamentals, very, very decent, guys. Their only little thing right here is the amount of debt that they're running. It's the only red flag that I found for the company. Other than that, EPS, very nice expansion, and revenue, also very nice expansion. And quick little tidbit on the debt, guys, is because they're expanding their data center services a lot over the past couple of years, and that obviously takes a substantial amount of capital to do. Now, in terms of the technicals, guys, this is one where we really have to, at least the way I trade, guys, I would be waiting on this one, right? It serves no purpose to chase it up here, even if it can continue to rally. It's just not the best strategy, right? We're trying to build principles and rules to respect because the trade is not what's going to keep us alive, guys. The strategy is what's going to keep us alive. And if we get into a bad habit of chasing stocks after they've ran, it could lead to some unfavorable circumstances in the future, right? Especially in terms of our long-term P&L. Now, in terms of our price action, guys, well, it's clear as day, right? Beautiful daily uptrend right now, a little bit overbought condition. So essentially what I would need to see, guys, for this one to be a more manageable position for me, I will need to see a retest of our prior all-time highs. If for whatever reason the markets have a little bit of a sell-off event in the next couple of weeks and Oracle is caught up in that sell-off as a byproduct, right? We could potentially be seeing a little bit of a retest of maybe the 128, 127 range, pretty much between these two lines here. I really like this company. 127 to 125 could be a great opportunity, guys, for the breakout, retest of the all-time highs, and then run later on in the year. So this is the type of trade I'm looking for specifically, rather than really trying to build positions up here and taking a chance at the all-time highs. So hopefully that makes sense for Oracle. The second one was CELH, and the only reason, guys, I'm doing two tickers for our subscriber right here is just because there's not a lot this week, right? So bear with me. So in terms of CELH, guys, waterfall drop on CELH right now. Dare I say a complete falling knife, right? It's clear as day. Unfortunately, guys, as of now, monthly is currently in a little bit of consolidation. Dare I say a monthly downtrend right now. Almost the same thing as happened right here, right? So very heavy consolidation from CELH. This is just because analysts are speculating that their demand is going to slow down. Now, management did hint they didn't hint, they flat out said it, that the revenue would be about $20-30 million lighter than the expectation coming into this quarter. But for some reason, over the past couple of weeks, guys, I mean, Wall Street really has been hunting these beverage companies hard. It's not a CELH problem. It is pretty much a beverage industry problem as a whole, stemming from a little bit of concerns over consumer discretionary spending. But these concerns, guys, are nothing new. These companies have been voicing these concerns for pretty much, for all intents and purposes, the last 6 to 9 months. So why they've had such an emphasis on this recently, that is just the way the cookie crumbles sometimes, guys, right? Just repricing these stocks, analysts pretty much reevaluating their price targets, right? So Monster, well off its all-time highs, big drop on Monster as well over the past couple of months, and even a company like Pepsi as well, right? Even Pepsi, guys, huge drop in the last 4 weeks of trading. Same concerns, guys. So it's not a CELH problem. It's really an overall industry problem that they're in, more specifically consumer discretionary, right? A lot of stocks have been suffering in that industry as a whole. So now weekly downtrend is underway, and now we're going to be looking for the bottoming out process. Now, obviously, guys, we would love to say that this is the bottom right here because we are approaching, for all intents and purposes right now, daily oversold conditions. And I pointed this out when I was looking for my trade on CELH last week. CELH really doesn't hit oversold conditions that often. Let me put a red line right there just so you can see how often it does it, right? Once, all the way back here, let's zoom in on this chart, right? All the way back here in 2021, we had one event right here where we hit daily oversold conditions, and we got a little bit of a bounce, right? It did take some time to eventually get a daily uptrend, and then we roll over, but at least we get the benefit of a bounce, right? Second time right here, daily oversold conditions, we get a little bit of a bounce, and then roll over, unfortunately, into further daily oversold. So even this entire region right here, guys, very tough to pick the bottom, right? You could have tried here, and still not got it until here. So it's really a price range, but eventually when we come out of those daily oversold, we do tend to get a nice little bounce. Now, obviously, this time could be fairly similar, right? In terms of the daily bounce, guys, we're not expecting the bulls to V-shape this. This is a long way to V-shape, right? So let's take a look at this, guys. Daily downtrend, clear as day. Our most recent lower high is right here. So let's say the bounce does start from here. It's such a heavy downtrend right now that the expectation is just for lower high and then potentially revisit or even break to lower lows. So if we're looking for this short-term bounce play, I mean, for all intents and purposes, guys, we can potentially start to build it here when we get the reversal of the hourly time frame. This is what we need to see, guys. No clear hourly trend reversal since the all-time highs. We had a little bit of an attempt here, but you can see never any new highs. So fact number one, guys, we need to set the hourly uptrend, and you can't really count this one here because it was a pre-market candle. When the market opened, we pretty much flushed. No hourly trend change. So what we need to see from the bulls moving forward, if you want to get a pinpoint entry, target the 15-minute trend change, which will then lead into an hourly bounce. Look for the hourly trend change. When we get that hourly trend change, we know the daily bounce is underway. And then I would maybe be targeting this line right here, right? Prior resistance area, the 200 daily moving average is sitting right there at about 66, 67. So maybe a little bit of a swing trade, but please, if you are going to take this, guys, not financial advice, of course, but if I'm going to take this trade, my stops are going to be super tight below the most recent lows, of course, right? So that is just something I'm looking out for on CLH. We need to wait till this one has bottomed, and unfortunately, it has not bottomed yet. If we do, we can just completely blast through this location right here, right? And then move on to our lower area of support. All I'm here to say, guys, is that I like the share price between $60 and $50. It's a lot more manageable valuation for the company. And when we went to do our valuation, we did the valuation at 76. It really wasn't that bad, right? And that was a 2.3. So if I was to redo this valuation right here very quickly, it's very easy to do. Let's just take the 2024 EPS. That's going to be $1.10, let's call it. So $1.10, let's say we're at $60 right now, right? 60 divided by $1.10 is about a 54 forward PE ratio. And if we're to divide that by their growth rate by 30%, which is they're still growing fast, 1.8. So now they're actually under 2. I like this company at under 2. So I will be shopping for this one between $60 and $50. It's just excessively tough, guys, to say exactly when this is going to stop dropping. That's why the only thing we can do is monitor for that hourly trend change into our daily bounce. And then if the bulls can get as high as possible in relation to this guy right here, guys, if we can see a bounce next week, let's say all the way up to the 618 level, about $69, $70, it gives the bulls the best chance at potentially recapturing this into a daily uptrend and reversing some of this weekly damage that was done. So hopefully that was educational for CLH and Oracle. Now let's take a look at James. James asking us for Intel. No problem at all. So let's take a look at how Intel has been doing. And as we can see here, pretty much over the last 3 weeks, let's call it, they've been really flat, coming into this big area of prior monthly support. Monthly support should be monthly support, and that is pretty much 30 all the way down to about $25, right? So Intel really coming down hard here over the past few weeks to arguably a few months. And that's just because of not only the increased competition coming from NVIDIA and AMD in terms of their data center businesses, right? Intel is just not ready for that type of business, but also increased competition from TSMC for their foundry business, which started all the way back here. This is one of the reasons that Intel stock had such a big drop back here, is they're just falling behind their peers in their both lines of businesses that they're trying to attack right now. Their foundry business, so manufacturing of semiconductor chips, they're falling behind TSMC, which is the industry leader. TSMC can just manufacture faster and better products, unfortunately for Intel. And number two, their data center business. They are trying to desperately attack the data center business, but unfortunately, and companies like NVIDIA and AMD and even Samsung, guys, have a little bit of a lead on Intel. So Intel has not been able to capitalize on the whole AI narrative run so far. They just don't have the product suite to do it just yet. And third, their personal computing division, guys, this is what really destroyed the company back here after the company pretty much brought forward a lot of its demand in 2021 and 2022 when people were looking for new computers, right? New computers, new processors and everything. They had their best years ever in 2020 and 2021. And then unfortunately in 2022, when people really started pulling back on their purchases, the company absolutely got crushed in the PC market, guys. And unfortunately for them, they've been facing increased competition from AMD in terms of their personal compute offerings, in terms of their CPUs, right? So everything really moving against the company right now. Couple that with the fact that China has also put a few restrictions on Intel chips, namely for government employees. Now, that's not a big deal, but it's just a lot of little news that just keeps affecting Intel as a whole, right? So let's take a look at some of the valuations here, guys, some of their financial metrics as well. You'll see that unfortunately they did get EPS crushed and they pretty much had to cancel their dividend as well. But now they are resuming on a better path. The best years for Intel from the company and analysts alike are going to be 2025 and 2026. 2024, a little bit of a transition year for them as well. Even in terms of revenue, right? We can see revenue largely flat compared to 2023 for this year, but 2025 and 2026 should be the years of redemption for Intel. So this one you're going to have to be a little bit patient with in terms of getting that really juicy EPS back and revenue back, right? in terms of their debt, there you can see, guys, they're running a lot of debt, right? Usually their debt was manageable back in 2020. They had a lot of debt back here, but they had a lot of free cash flow and a lot of cash and cash equivalents. That has since changed, guys. Almost no free cash flow to speak of. As a matter of fact, a few of their most recent quarters have been net margin negative. Now, we don't expect this to be a trend for the company, but it just goes to show they've been spending very, very heavily on capital expenditures to keep up with the competition, guys, and that is what's piling them on a little bit more debt. Compare this with a few of their industry peers, right? Compare this with their foundry peer, which is TSMC. TSMC, guys, has virtually no debt and is flush with cash. And if we compare this to their closest CPU chip competitor, right, AMD, you can see once again AMD too, guys, flush with cash, not a problem for them. So unfortunately, Intel's balance sheet is really not the best in relation to its competition, right? So that is just one thing to say. Now, in terms of the valuation of the company, guys, now, in terms of Intel, guys, they are only running a 0.93 PEG. EPS growth is very, very good because they're coming off a bottom pretty much, right? So that's why the growth is so high, which gives them a PE ratio at $31 of about 28, not too bad, and a PEG ratio of about 0.93, which is under 1, also not that bad. So the company on paper is a little bit cheap, even though with all the current things that they're facing right now. So all in all, guys, for a short-term swing trade, this is very, very, very difficult, guys, because even though we're bottoming out right here, you can see the bulls over the last 4 or 5 weeks just have not done anything right now, right? No bounce to speak of. Very, very weak bounce. Dare I say, if the markets overall have a little bit of weakness, Intel may just retest these lower levels. And this is where I really like a lot more. Between $28 and roughly $25, a much deeper area of support for Intel specifically, right? Couple that with the fact that we are almost weekly oversold and we are coming out of daily oversold. We're no longer, right? So if we get a few more weeks of red into this location right here, it will put us in weekly oversold conditions. And I do believe that could represent a short-term swing opportunity. At least if we come back down here towards the most recent highs of 30.31, right? So if we come all the way down here, 27, stop goes below 25, and then our trade profit is right around here, $30, So decent risk to reward, in my opinion, for a trade like that. In terms of a long-term portfolio ad, guys, it really comes down to your thesis on the company long-term, right? If you truly believe in Intel's recovery story, which a lot of people do, then obviously we have to be buying these types of companies when there is so much fear, uncertainty, and doubt. This is when the money is made on long-term positions, when we buy companies when they're at their lowest point in terms of analyst expectations and in terms of media expectations as well, right? So in terms of a long portfolio ad, I wouldn't be opposed to it, but just keep in mind, guys, we're trying to play for a recovery story here. The recovery story is not guaranteed, right? It is a theoretical recovery story. So let's just keep that in mind. And also, the peak of the recovery story may only start to really poke its nose out later on in 2025. So it could be some time. If we acquire some shares here, don't be surprised if we have to sit on them for quite some time before Intel really starts making leaps and bounds, in terms of fundamentals to really start supporting a higher share price. So let's keep that in mind, guys. Hopefully that was educational for you, James, on Intel. Now, let's take a look at CRM for Prakash. So asking about, he bought some $230 calls expiring July 19th. Well, obviously, Prakash, it's tough for me to know when you bought the calls, right? Are you in profit? Are you in a loss type of thing, right? So it's tough for me to know exactly your call position there, but let's at least do some technical analysis on the CRM position. So CRM, pretty much, you guys know what happened, right? If you don't know what happened to CRM, you can always go back and watch my video roughly from 2-3 weeks ago after their earnings on my channel. We give a full breakdown as to what happened for the company. The essence of what happened to the company is the growth is slowing. However, other aspects of fundamentals are improving. It's a little bit of a paradox for CRM, right? For a very long time, the past 2, 3, 4 years, there's a lot of activist investors that have been asking CRM, listen, stop buying other businesses, stop racking up debt, and start focusing on net margins. Start focusing on free cash flow and start focusing on your bottom line margins. Stop buying other companies, right? And focus on those two things internally. And the CEO, being the very receptive person that he is, understood activist investor complaints and started putting them to action over the last 6 months. So in the last 6 months, guys, CRM has done a great job at expanding its net margins and really improving free cash flows. We can see that through here as well. very, very net improvement in free cash flow over the last couple of quarters in relation to, just 6 to 9 months ago, right? So they are focusing on the good things. And you can see here, 2023, they did do a great job of bringing free cash flow to arguably the highest year in company's history. So he listened. However, that is now coming at the expense of growth, since CRM is known to be a company that doesn't really grow organically, right? It doesn't grow from the inside out. It kind of buys competitors and assimilates their growth into one single company. So that is the problem for CRM right now. Although they have improving internal fundamentals, which is what shareholders asked for, well, now they're being hit because they're not growing because they're not buying other businesses, right? So a little bit of a paradox for CRM right now. So in terms of the technicals, guys, I do really love CRM. If ever we revisit this lower range right here, huge support in my opinion, guys. 211 down to about 200, and the valuation of the company down there gets really, really good, right? At 230, where it is right now, it's about a 1.46 peg. If we come down another 10-15%, this number should get closer to a 1.25, 1.3, and that's extremely attractive for such a solid company like CRM that I really don't believe they're going anywhere, right? They are the industry leader for customer relation management tools and software, and I don't believe that moat is going anywhere anytime soon. Now, in terms of the technicals, guys, monthly uptrend, yes, but the bears have taken back so much of this move at this point, guys. Take a look at the size of this drop, almost 80% retracement by the bears. So you guys know the drill. Usually it's very, very hard to V-shape recover this to the all-time highs. The best the bulls can do is get some monthly consolidation, something like this, and reset the monthly uptrend later on, right? In my opinion, it is going to be a two-step process. So that's why I say if we can really get some of these lows down here, it could be a great location for an intermediate swing trade location or even a long-term portfolio add right now, right? In terms of the weekly, guys, still a pretty much weekly downtrend, no change there. The bulls are trying their best to reverse this into a weekly uptrend. Still no sign of that yet. So we really need to monitor, as we've now lost the daily uptrend, need to monitor when the bulls can ever get this back. If they take back too much of this move, daily downtrend, that's what we're going to be looking at for some positions down here, guys. So in terms of the $230 call option, I mean, it's pretty much at the money right now. Prakash. You know, it's very, very tough for me to give a sense of where this one is going, right? I would love to say that, yes, we can definitely have some further upside, but in relation to my videos that I posted on the QQQs last week, we're very overbought on the QQQs, right? The market is not that broad. I would not be surprised if the overall market does drop. That may be the last opportunity for CRM to dip, and thereafter, we may just start that rally in maybe a couple weeks' time to about a month, right? So just keep that in mind in terms of CRM. I'm not expecting the company to really make huge leaps and bounds right away necessarily. I could be wrong, but that's just my expectation for the company. Now, moving into Minion asking us, can we please consider reviewing SOFI? Absolutely, we can take a look at SOFI. I play this one been playing this one every single week since pretty much the month of May. So SOFI really doing a great job at turning around their business currently, right? It went from an unprofitable company to now pretty much being a profitable company, at least in the last 2 quarters running. And they do say that that profitability should continue. Now, in terms of their balance sheet, right? Nothing really wrong with their balance sheet. They have a tremendous more amount of cash than they once had. They've paid down a lot of debt. Now you can see as the most recent quarter, they finally have more cash than they have debt. So balance sheet is looking very, very good for the company, which was one of the big things that people were criticizing them for about a year ago. EPS finally coming into EPS positive territory here over the next 3 years, and revenue expansion is very, very, very healthy for the company, right? Now, since the company is just coming into profitability, we can't really do any EPS analysis. The best we have right now is price to sales. So in terms of the market cap, we're sitting about 6.83 billion. And last year, the company brought in roughly, let's just call it 3 billion for all intents and purposes, get a round number, right? So the price to sales is about a 2.27. That is okay, guys, for a company that's growing in a very healthy fashion, right? About a 2.67 price to sales is 2.27 price to sales is really not that bad. It's actually coming into arguably value territory right now. So in terms of SOFI, in terms of the technicals as well, what happened most recently this week, guys, is you guys obviously know if you read the headlines, well, unfortunately, one of SOFI's largest investors had to get out of the stock. This was an investment fund from Qatar, and they were pretty much in the stock since the IPO. This company had a lot of preferred shares and warrants, guys. So they weren't necessarily exposed to the common shares, but they did redeem a lot of those preferred shares and all of their warrants and pretty much liquidated them over the past 2 days of trading, which was a big drop in the stock. This is what happens when you're forced fourth largest investor simply pulls out of the trade. They're not pulling out of the trade because they don't believe in the company. It's just they've made a lot of money on this company so far, and I guess it was just time for them to take their profits and move on to something else. In terms of the technicals, of course, we've now really fractured our lowest level. So now, very, very unfortunately, guys, right, it is still a monthly consolidation range, even though it is to the downside, right? We could derive a descending wedge like this. And usually when we have, or rather, you can call it a wedge, or you can call it pretty much a longer form bull flag, it is looking very good, guys. Usually these types of patterns do tend to break bearish, bullish, especially when they're on the longer term time frames. We just have to be patient, guys, because this one is not in a very favorable, industry right now, just because of high interest rates and what SOFI's business model is, right? So as soon as interest rates start coming down, I do believe this stock will get a lot more love than it is currently getting. Right now, guys, it's just a game of accumulation. Very tough to time the exact moment when SOFI will finally start breaking up and setting that weekly uptrend, but I will be looking for it. So far, no real weekly uptrend on SOFI, guys, since pretty much all the way back here in the month of March. Ever since then, guys, it's just been a steady weekly downtrend. But the bears are probably going to get tired a little bit further down here as we move into the $6, if ever we do get there. Unfortunately, not yet daily oversold. I like this lower level right here. If we do, for some which reason, guys, head to the $6 range, I will be adding to my SOFI position because I do have 1,000 shares at $7 right now. Would be very nice to add some down here. So this one, guys, in terms of the long term, just going to have to be very, very patient with it in terms of the company getting some love from Wall Street. It's not something SOFI specific. The company itself is doing great. It's just the overall industry is currently being held down by high interest rates right now. So the first thing we want to look out for that eventual, weekly trend conversion to the bulls, well, unfortunately now we have to do it all from start. We have to look first for the daily uptrend to form. And then when the daily uptrend forms, we look for the size of the weekly bounce in relation to our most recent weekly lower high, which is pretty much this guy right here. So as soon as we get that weekly recapture, we need to measure the size of the bounce and then can go for the weekly trend change. If we get a pop back above 7, retest 7 could be another juicy location to enter. If ever you're a bit worried down here and you don't want to pick the bottoms or something like that, I would just be waiting for that weekly trend recapture, re-entry around $7 if it does do the infamous breakout retest of the range. So now pretty much moving on to the last one. J Die God 88 asks, can we do AXP? No problem at all. So AXP, we're going to take a look at them, most likely because I talked a lot about Visa and MasterCard in last week's video. After looking at Visa, right? Visa coming in to this great location of support that they've been pretty much building for the past 2 months right now. And even a company like MasterCard as well, pretty much the same graph, building some very healthy support, trying to set pretty much the monthly higher lows on the chart. For MasterCard and Visa, same thing, right? Trying to set up the monthly higher lows for the further trend continuation. Now, the reason I didn't talk about AXP, guys, is because AXP still has not set a relatively good base of support similar to Visa and MasterCard. Visa's support level is pretty much 2 months in the making. MasterCard's support level is also pretty much 2 months in the making. American Express, however, is very fresh, right? They had a tremendous rally, but did not set many areas of support in the process. So now we only have a few levels to base ourselves off of. 222 down to about 215, good little area of primary support. When we take a look at the monthly here, guys, we're still very far off any semblance of monthly support, right? Your first target would pretty much be the 12 monthly moving average right here at about 205. But so far, other than this little area right here, really nothing between us and the all-time highs, right? So it does need to consolidate a little bit more, in my opinion. I still love this company, guys. You guys know it's one of my favorite companies. The PEG ratio at 225 is really not that bad. And compared to, excuse me, guys, compared to a lot of other different credit card companies, their consumers are not really in fear of a recession, right? They target more of a luxury customer. Give me a quick second, guys. It's all that talking, right? Excuse me. So they're really not that bad, right? Still one of my favorite companies, growing very healthily. It's just in this location here for a little bit of a swing trade attempt, no problem at all. But if we're looking to take longer term positions, guys, although it is a great company, I personally need to get a little bit more of a sell-off on this company. I would be more attracted to playing this one for some size, let's say, between 200 and 205. If we can ever revisit those levels, I will play it with a little bit more size, but no reason to no reason to not be playing this company right now if you want to play these daily oversold conditions, because American Express very rarely gets daily oversold conditions. And when we do, we usually get a decent amount of bounce, right? Get a decent amount of bounce off these. Not saying that the bounce necessarily has to take us back to the all-time highs, but at least we will get a little bit of a bounce. So if we're looking to play a little bit of a bounce here, well, the stops need to go below these lows right here, 215. So we're looking at about $10 worth of risk. And maybe we're targeting this prior level of resistance right here at about 234. So, you know, the risk reward right now is kind of equidistant, right? $10 of reward and about $10 worth of risk. So the best we can do is maybe try to get a little bit lower pricing here. If we can get below 220, 217 with continued daily oversold conditions right there, well, that may be a little bit of a swing trade opportunity, because then our risk is very tiny and our capacity to get reward is quite large. So that is the way that I would play American Express. But all in all, guys, as you can see, right, weekly almost engulfing move, taking back a lot of this move on American Express, almost 80%. Usually when that happens, guys, it's synonymous with a little bit of maybe range-bound consolidation for the foreseeable future, which would not be a bad thing for the stock. If they can set further bases of support down here, just kind of use this area of support, it'll establish a longer form base, and then we can play off that area more heavily in the future, right? So American Express, bit of an in-between right now in terms of a trade, right? That's pretty much everything for our subscriber requests. Now let's go over very, very quickly, because I spent a lot of time on this video just because we had so few requests. I went into each one with a little bit more depth, right? So now we've done those. Let's take a look at some of the companies that I'm looking to buy. Number one is going to be Vici. Now, if you don't know about Vici, guys, they are one of my favorite REITs, arguably my favorite REIT, real estate investment trust, in the entire market right now. They're coming down into a very juicy area of support, which is pretty much the 27 all the way down to roughly 25. Very strong company, guys. They are the landlord for the MGM brand in Vegas. So they do not operate the casinos. They are just the landlord. They own the properties. And MGM and other casino venues rent from them. The rents are also directly linked or indexed to inflation, so they are never losing pricing power in the form of rents. Very, very extremely well managed company, and they do pay almost a 6% dividend. I would not be surprised when interest rates do come down here, guys, that we finally start to get this extended rally back in Vici, similar pretty much to the solid gains they've been putting in when interest rates were at more manageable levels, right? So kind of getting lagged behind, not because the company is doing poorly, the company is actually doing great, just because it's part of the larger interest rate sensitive trade. So that is one that I'm looking to build a larger position in the coming weeks. Moving into the next one, guys, going to be looking at CP. CP, one of my favorite more defensive value plays, just because they're almost a monopoly right now, guys. Them and them with their merger with Kansas City Rail, it's pretty much them against UNP, Union Pacific, right? So those are really the two biggest railroad companies in North America right now, and you're looking at pretty much the best run one, in my opinion, right now. Tremendously good management team, to say the least. Very, very good fundamentals as well. The company is growing, and as I said, guys, it is a monopoly. Now, we've been pretty much range bound for pretty much the last arguably 3 years of trading, although the company's fundamentals have been getting a lot better, right? So take a look. Very nice EPS expansion forecasted for the next couple of years, and very nice revenue expansion forecasted for the next couple of years as well. Extremely, extremely strong companies in a company in the years to come. The reason they've been flat is because they had flat EPS and a roughly flat revenue here before their merger and acquisition of Kansas City Rail. That's why they're flat, but we're looking for that trend expansion as we're getting better fundamentals for the foreseeable future. So this location right now, guys, 76 all the way down to roughly $70. Let's call it a juicy buying opportunity for some steady gains. I mean, look at this chart in the long term, guys. Can't really go wrong with such a well-run company, in my humble opinion. That's company number 2. Now, company number 3 we're going to be looking at is another one of my favorite retail discretionary trades, right? A lot of people like to talk about Nike, Starbucks, all your other consumer brands like Lululemon and stuff like that, but nobody ever talks about Louis Vuitton, despite being one of the most solid run companies in the world that targets a luxury segment. Rich people do not lose money in recessions, guys, right? So this company will continue generating massive amounts of revenue, massive amounts of cash flow every single year forward. Take a look at their forecasts for EPS growth over the next 4 years. Very good EPS expansion and very good revenue expansion as well, as they continue expanding their luxury brands, right, guys? They own about 70, 80 different luxury brands right now. They are pretty much the conglomerate, right? They are on almost a monopoly for luxury brands at this point in time, right? So going with this company is a very, very easy bet for the foreseeable future, in my opinion. They do well during recessions, but they do even better coming out of recessions as well, right? So this one, I've always said for on the channel for at least the past year at this point, right? The whole 165 down to 143 level is an extremely juicy, attractive level to be buying the stock. We're just consolidating here at the top end of our all-time high range pretty much. And anytime we get a little bit of a dip here below 150, I'm always adding some shares into my long-term portfolio, just eventually looking for that eventual monthly trend expansion to the upside. Very nice company for any long-term portfolio, guys. Company always continues to grow and continues pushing net margin expansion, and the management team is very, very exceptional. Now, company number 4, guys, is going to be one that I talked about all last week. It's going to be Visa. Very, very easy play, guys. I mean, what's complicated about this play right now, right? Decent PEG ratio. Visa is always runs a little bit rich, just like MasterCard, because they're so consistent, right? Company has really been coming down for the past 3 months, just looking to set these monthly higher lows in place, maybe tagging the 12 EMA. So from here, let's call it about 266 all the way down to maybe 258. This little pocket right here could be a tremendous opportunity to start a little bit of a position on Visa for the future growth of the company, right? Visa, you guys know this chart, right? It's absolutely beautiful. That's why whenever you get a little bit of a touch of this 12 EMA, it could be a great location to add some shares. Look, just tags the 12 EMA and continues going up, except for when the entire market was in a disaster, such as 2022 and during the pandemic, right? But any touch of the 12 EMA could be a great buying location. Couple that with the fact that we're really trying to find a bottom location for support. So I would not be opposed to playing the stock here. And then if it does go a little bit lower, to our 12 EMA as well, down to about 260, well, then we can add a little bit more. That is the way that I'm going to be playing Visa moving forward in the foreseeable future. Very gorgeous company at a decent little level after, you know, several months of consolidation at that point. This is when I love adding to this style of company. That's pretty much everything I had for you guys in today's video. So hopefully you guys appreciated that. If you did, consider dropping a like. Would really appreciate it for the growth of the channel. Also consider subscribing to the channel if you're new. We do these videos every Saturday for subscriber requests. And then obviously Monday through Friday, we do the daily market recap. So hope to see you either in these videos or in our daily market recaps. And now lastly, guys, if you have any questions at all, or if you want your ticker to be featured in one of these videos, just leave your ticker down below in the comments. And as I said, I will be doing them on Saturdays. So take care, guys. Have a great rest of the weekend. I'll see you tomorrow night for our top 5 options play video for the upcoming week. Peace.